which today we're gonna deal with the part of the inventory starting from 7.4. Here now we'll be dealing with the elimination of the intra-group items, especially the part where either subsidiary or parent is selling their inventories. So we have to know whether did we realize the profit with regard to that particular inventory, or is there any unrealized profit. So if there is any unrealized profit, then it needs to be eliminated. And the one which is realized, it will be taken into account into the preparation of our consolidation. So from the 7.4 paragraph, they say, as mentioned previously, the purpose of the consolidated annual financial statement is to offer the annual financial statement after the elimination of all the intra-group transactions. And then we should eliminate those profits or losses on transaction within the group, as the group is regarded as one economic entity and it will not enter into transaction with it itself. So in this case, now we have a situation where we've got inventory, like we've got a parent who sells his inventory to subsidiary, and then subsidiaries sell the inventory outside the group to a company called X. So in this case, suppose P Limited, which is the parent, sell inventory to subsidiary as a cost of 1,000 plus 20% profit, and S Limited packs the inventory and sell them to X, then a company outside the group at 1.5. So we as the group, there will be a profit of 20%, but the one outside group, then it will be, because from 1,000 plus the 20%, it will be 1.2. And then from 1.2 to move to 1.5. So it means S Limited will be realizing a profit of 300 on top of that. But we're going to only focus on the profit within the group, whereby parent was selling to subsidiary and they made a profit of 20%, which in that case, it was 200. Is the one which we're going to focus more on. So out of that scenario, now we come up with the other additional situation. One is a situation whereby all the inventories have been sold to X Limited by the end of the year. And then there will be no change to the consolidation annual statement, as the profit is actually realized by selling it to the company outside the group. So in this case, P Limited sold to S and then S sold to X. So since all the inventory was sold outside the group, so that profit is going to be recognized. So in this case, there won't be any unrealized profit because all the profit was realized. So the elimination is only on the unrealized profit. So immediately we have the unrealized profit is the one which need to be eliminated. So the unrealized profit is it will lie more on the inventory which was not sold. So that particular inventory which was not sold is the one which that profit we need to eliminate. And then another situation here, we've got the situation whereby we've got, they say if no inventory have been sold to X, so it means here is the parent sold to subsidiary and then we stop. If no inventory have been sold to X, we should eliminate the unrealized profit of 200. So remember, the cost was it was cost plus 20%. So the plus of the 20%, it was 200. So it means the profit realized there, it was 200. So as the profit of 200 has not yet been realized outside the group, the inventory of S Limited and P Limited profit include this amount. So our inventory as group, it will include the profit of 200 because that profit was not yet sold to the other parties outside the group. So that 200 somehow it needs to be eliminated because it will form part of the unrealized profit. So to eliminate the unrealized profit, subsidiary has to subtract the 200 from its closing inventory. So it means at the end of the financial year, subsidiary will be having an inventory of this much. So out of the inventory that he have to deduct the profit of 200 because that profit, it was not yet realized, or the inventory that he didn't sell to the other third parties. So we as the group, we know that we have a profit of 200 that need to be deducted so that it will be realized in the future financial years. So we're going to subtract the 200 from our closing inventory, while P Limited, which is a parent, has to decrease its profit by debiting the cost of sale. So we as the parent, we're going to reduce our profit, while the subsidiary will reduce the inventory. So let me go here. So analyzing, okay, hold on. I'm going to share the Excel part. Okay. Now we want to analyze the issue of the profit. Analyzing. I inventory being sold outside the group. So the minute we have a situation whereby the inventory is being sold outside the group, so that particular inventory which is sold, they're going to realize a profit. So the profit will be included in our consolidation, but the one which was not sold, which is still remaining in our asset, the inventory that is remaining with us, we have to deduct that particular, the profit from that particular inventory. You need to be deducted so that we don't recognize it because it's not yet realized. So in this case, we've got the parent into subsidiary, and then the subsidiary also sell that particular inventory outside the group. So the subsidiary sell inventory outside the group. So we've got inventory of, we're gonna just assume that A sell inventory of 1,000, B, and then B sell same inventory to C. Then the profit. So when we're gonna close our books, now we want to eliminate. Elimination will be the unrealized profit by subsidiary will be eliminated from the inventory. So take note of that. Will be named from the inventory of subsidiary. And then another part, the unrealized profit will be eliminated from while P limit has to decrease its profit by taking the cost of sale. from the cost base. Because remember, parent was the one who sold inventory to B, and then B decided to sell it to inventory. To C. So since B sold that inventory, so if it happened that maybe they sold the 50%, so the 50% which was not sold, it need to be that particular profit from the 50% inventory is the one that need to be eliminated from our consolidation. So let's have a quick look on our example from the scenario on page 116, where they say, first you have to decide, you have to know who is selling what so that you can able to know which part are you eliminating. We've got a situation whereby we have an inventory being sold to S Limited. A very important aspect of consolidation is to determine which company is selling the inventory and which company is buying them. We've got P Limited who sell inventory to S, and then if P sell inventory to S Limited is making the profit. So in that case, no adjustment to non-controlling interest is necessary, because the non-controlling will be the portion which is owned by the subsidiary. So since he's the parent selling to subsidiary, the non-controlling, it doesn't have any impact, because normally we show the non-controlling in the analyzed shareholders of the subsidiary. But if now we have a situation whereby the subsidiary is selling the inventory to the parent, it means the subsidiary is going to make a profit. So since the subsidiary is making a profit, we'll have an impact on the non-controlling interest. So that profit which is realized by the subsidiary, it's going to be eliminated from the non-controlling interest. However, you must note that any unrealized profit, now it's going to be eliminated from the inventory of that particular subsidiary, together with the retained earnings on the analysis of shareholders, as well as the retained earnings on the statement of changes in equity. So if S, which is subsidiary, sell inventory to P Limited, the S Limited is making a profit, and the non-controlling interest must be adjusted by its percentage interest in profit, so that we eliminate that particular unrealized profit. So now let's have a situation on example 1. Now we're going to start with a situation where the parent is selling inventory to its subsidiary. So we're going to have a movement of inventory, and then we have to check whether does it affect the analysis of shareholders or it doesn't affect it. So we've got a pre-adjustment trial balance, which for the year ended 31 December 2008, which is A Limited and B Limited. Now, on the additional information, they say A Limited acquired its interest in B Limited at the time of incorporation. That is fine. Then we'll check how many percentage they own. And then B Limited, which is the subsidiary, purchases all its inventory from A Limited at cost plus 25%. So it means the profit to be realized here is 25%. So 25% of the profit will be realized by B Limited. So the inventories on B Limited financial record amounted to 20,000 at 1 January 2008. But at the end of the year, now the inventory is sitting at 30,000. So it means along the year we increase the inventory by 10,000. So the total sales to be limited during the 2008 amount to 100,000. So it means in this case, B sold some of the inventories to A Limited to the value of 100,000. So the sales is 100,000, and on the other side, in the books of A Limited, we'll have purchases of 100,000. So those intercompany transactions or the sales, they're going to be eliminated. We're going to, on the sales part, which it was on the debit, now we're going to reverse it, which is going to put it, it was on the credit. So now we're going to put it on the debit. And then on the purchases, which it was usually sitting on the debit, now we're going to put it on the credit so that we cancel each other. So now we're going to draft the consolidated annual financial statement for A Limited Group for the year ended 31 December in compliance with the requirements of International Financial Reporting Standard. So now we're going to start with our analysis. So let's tackle example 1. Example 1 on page 117. So we're gonna draft our analysis of shareholders. Analysis shareholders. And then first, let's check, is the parent selling to subsidiary? Then assumption is that subsidiary will sell to the business outside the group. Inventory to business outside. So in this case, our subsidiary, the parent is realizing a profit. And subsidiary will also realize a profit if sell outside the group. Okay, and then now let's go to our analysis, which that one will be the common thing, especially the top part. So we're not gonna dwell more on it. So our analysis, we have the at acquisition, and then we have the, it's gonna be A Limited, which is our parent in this case. So here we're doing the analysis of, normally we know that the analysis mostly is for the subsidiary part. So we know that A Limited in this case own 80%, which we know how to determine that 80%. I'm not gonna show it, we already know. So we've got at acquisition, A Limited, and then which it will be our total. We've got the at, and then we've got the since, and then we've got the NCI. Then we have the share capital. Our share capital is sitting from the subsidiary point of view, it's 100. And then the percentage will be the 80% because we check that they own the 80% of the interest. So it will be the 80,000. And then here it will be the 20,000. And then we don't have any retained earnings. The retained earnings that we have is on 1 January 2008. It's for the current year. We don't have any retained earnings during the acquisition part. So this one, it will be dash. And it will be dash here. I can say 0, 0, and 0. Then we have our total here. We have the 80,000. And then it will be the 20 on the other side. And then the since acquisition part. So the since acquisition to the beginning of the current year. Okay. So our retained earnings as now is sitting, the retained earnings on 1 January, it means is now sitting at 80,000. That is the beginning of the year. So we're gonna put our retained earnings as 80,000 because it's the one at the current, since acquisition to the beginning of the current year, then we put our retained earnings which will be the 80 as projected from our pre-adjustment trial balance. And then we put our 80% of it, which will come as 64. And then we put our difference here, it will be the 16. Now we have the current year where there were things happened during the current year. So now is the current year. So normally on the current year, we're gonna have a profit. The profit realized by the subsidiary. So now we have to calculate the profit for the year. When we check on the current year, we have a profit before tax, which it was 60,000. And then the taxation for the year is 20,000. So in this case, because it was parent selling to subsidiary, it's not that movement of the inventory being sold is not going to have any impact on the analysis of shareholders, because the analysis, remember, is only dealing with the things that they happen under, especially for the current year, the one which they are done by the subsidiary. So our profit by subsidiary will be the 60,000. I mean the 60,000, which it will be profit before tax. 60,000. The one for the profit before tax, less the 20,000 as the taxation for the year under B Limited. I mean, sorry, 20,000. 20,000. Then we have a difference of 40. And then the percentage of that 40 in the 80% with 32. And then we have the difference of 8,000. I want to check something here. Okay. Then, so our analysis of shareholders in this case, it will be close. It was not complicated because we didn't have any issues with regard to the subsidiary selling to the parent. So it means, in a nutshell, I will say, when parent is selling to subsidiary, no impact will be shown in the analysis shareholders, as the analysis of shareholders is only deals with movement of the subsidiary. Analysis of shareholders deals with movement of subsidiary. Then let's continue further. We're gonna tackle the consolidations, or we're gonna do the pro formas. So now we tackled the analysis, we are happy with it. Now we're gonna do our pro forma journals. So under our performance journals, or the which we call the, what do you call, there is this name, why I forgot the name, the elimination. On our performance journals, so we have on our, it will be the debit credit as usual, DR, and then CR. So we have our share capital, which now is going to be eliminated. The share capital and the investment plus the non-controlling. So on the other side, it will be investment and the NCI. I will just use the abbreviation because so that we can save time on the other side. So we have the 100 because we know that is from the share capital or the one for subsidiary. And then we have on the credit, it could be the 80,000, which was the investment that we purchased. And then we have the 20,000, the one for NCI as calculated. And then which now the balances, then there will be the retained earnings. So the retained earnings, it will be the one during the current year. So we have the retained earnings. And the NCI. So here is the current year. The one which it came as a result of since acquisition to BGN of current year. So it will be the one of the 16,000 because we focus on the non-controlling part. 16 and the 16 on the credit side. And then from there we go further. We now do the NCI alone, is the 8,000 from the current year part. So it will be the 8,000 and the 8,000, which it will be the NCI on the SCI and SFP. So it's NCI on the statement of change in equity. And then we have the on the credits and also NCI, but the one affecting the SFP. Now we go to the 100,000. If you check on your study guide on page 120, we have the income sales. So since they said, they did mention from the page 117, whereby they say A limited total sales to B amount to 100,000. So A sold the whatever inventory to B limited, which is 100,000 is the sales. And then on the other side, it will be the purchases made by B. So B purchased inventory from A limited. So those are the intra-company transaction, they need to be eliminated. So our sales, which normally it was on the debit on the credit side, when we record the individual account, we have to, because when we open our individual account in the books of, let's start with the books of A Limited, A Ltd. Okay, sorry, let me put it here so that it can say A Ltd. Initially, when he do his books, he will have bank or trade and other receivable, depending on the kind of a transaction. It either can be bank on the debit, or it can be slash the trade payables, not payables, receivable, depending on the nature of how does he sell his inventory. They are also go both on the debit side. Or let's say in this case it's 100,000. So we're gonna debit the 100,000, and then we have sales on the credit side. On the credit side of 100,000 also. And then we say GR and then CR. And then we have on the books, here's A Limited. And then on the books of B Limited, it was gonna be like this, B Ltd. Ltd. He was gonna have purchases on the debit side. So it's either a purchase or we can say purchases slash inventory. So he used what to purchase? He used the either cash, which is from a bank, or it will be the trade payables, which this one, it will be the 100 on the debit side and the 100 on the credit side. So now we are here to be limited. So the purchases was made to be purchased from who? From A. And then this one was sales to B. So now we eliminate, we eliminate the one which they don't have the contra account here, which in this case, the sales part and this one is the one to be eliminated. So since here they were having so you know when you eliminate, you're gonna do the inverse. So you do the inverse of this. So this one, since it was on the credit, now it's gonna go to the debit. And then since this was on the debit, now it's gonna go into the credit. So the purchases, when they go into the credit, so it will reflect as a cost of sale. Okay, up to so far, everything all makes sense, right?
Yeah, makes sense. I'm just trying to
Okay.
clear my head, yeah, but it makes sense.
Okay, so now we're gonna do the elimination part, which the elimination is because here they said A sold inventory to B, and then I'm sorry, they said our parent sells inventory to be limited. So it means we realized a profit. So if there is any inventory which was not sold, now that part is the one that need to be eliminated. So here we're gonna do our contra account, which is we just take this. It was on the credit. We're gonna come to the debit side. We're gonna say sales here. Of the sales was from in the books of who? Of the A Limited. And then we say A Limited. And then we have the contra account, which now it's gonna be the purchases. So the purchases, we regard them as a cost of sales. Because remember, when you do the main big account, it's gonna be the cost of sale, because there are the determination of the cost of sale, it will be the opening inventory, the purchases, and the closing inventory. So it means the contra account of the purchases, it will be the cost of sale. So on the credit, the cost of sale, on whose book? On the books of B Limited. So it will be 100, and the 100 here. Then now the big part, the elimination of the unrealized profit. We were told that A total sales to be limited during the 2008 amount to 100,000. So initially, we can say the opening inventory of B Limited, it was how much? It was 30,000. I mean, sorry, the opening inventory of B Limited, it was, they did tell us somewhere. Okay, the purchase of all its inventory from A Limited, the cost plus 25%, and then the inventory on B Limited financial records amounts to 20,000 on 1 January. So here's 1 January. We've got 1 Jan. Let me put it here somewhere down the line. So the inventory part, inventory of B Limited. B. So we have an opening, which it was 20,000. If I had opening is 20,000, opening inventory, then there were purchases made during the year. Which is now at 100,000. Now they tell us that it means now they're gonna do 120, because when we add them all together, and then they tell us the closing inventory amount to 30,000. So the closing amount to 30. So it means the inventory sold up to so far. The sales made by the B Limited to people outside. Sales by B Ltd outside group to entity let me track this further. I will add few columns. Search Okay. So the sales will be, we've got 120, then it means approximately 90,000 is the sales made outside the group. Now we're gonna focus on this. The unrealized profit. Okay, let's change to, okay. So on the unrealized profit, because I had an inventory of 20,000, which I purchased from A Limited. So I sold it. So out of this 120, I mean, out of this 90,000, there is that 20,000 which I realized. So, and I purchased additional inventory from A Limited, and then I end up selling whatever I'm selling. So now I have the closing inventory of 30,000. So on the closing inventory of 30,000 is not yet from the purchases that I made during the year of 100,000. There is 30,000 which I did because I didn't sell. So if you can check this, they will balance. I have opening inventory of 20,000. That's my opening. Then I made the purchases of 100,000. So my total inventory is sitting at 120. So I made sales of 90,000. So my 90,000, if you deduct the 20,000 sold, I mean the 20,000 of the opening, I will remain with the 70,000. So out of the 70,000, when you deduct it from the 100,000, then you are left with 30, which 30 represent the inventory not yet sold at the end of the year. Do we get it? Do we get the part of the 30,000, even though it's shown from the book from the period adjustment trial balance? But from this example that I'm demonstrating, do we understand it? This 30,000.
Okay. The way I was looking at it, so if you're saying, okay, we worked out, okay, sale, okay, we took the closing inventory because I just said the 120 minus the closing inventory which was given, right?
Yeah.
So that's how I worked out the 90,000. Is that different maybe from what you?
Okay. So on your side, you said 120 less the 30,000 of the closing
Yes,
inventory.
of the closing inventory.
So it means the sales to outside the group is 90,000.
Yes,
So this sales of this 90,000, it comes as a balancing figure because we were not given it. It's a
yeah,
balancing figure.
yes, yes,
So we just want to determine how many inventory was sold to the
yeah.
people outside the group. But that is not our main focus here. Our main
Okay,
focus will be on this
on the,
closing one,
on the
the
30,000.
30,000.
Okay,
So
okay,
since this 30,000 is not sold to the public, so there is a profit sitting on that 30,000. So now we want to deal with this profit, the profit sitting on 30,000. And they did tell us that out of whatever inventory that we purchased from A Limited, there is 25% cost plus the profit that we're going to realize. So
mm,
it means now we want to take out the profit on this 30,000. We want to determine how much is the profit from this 30,000.
okay, okay,
Yeah. So now we're going to say our 30,000 we times by 25% or 25, not, and then we divide by the 125 because they told us that they sell at cost plus. So cost is sitting at 100. So our cost normally is 100. Cost equals 100. And then profit, sorry, let me do this. Cost is 100. And then profit is 25 because they say we want to realize the profit of 25. then it means now the total markup, the total, it will be 125. So that's why now we're gonna say the 30,000, because we want to realize, we want to determine the profit from the 30,000. That's why we say 30,000 times 25, and we divide by 125 as the total, which would give us the 6,000. This is 6,000. So it gives us the 6,000. So this 6,000 is it gonna be called unrealized profit because represent the inventory which was not sold yet, was not sold to the public outside the group. So this will represent unrealized profit. So this unrealized profit is the one to be eliminated here on our journals. So on our journals, we're gonna do the cost of sale, because it represent the cost of inventory we purchased from our A limited. So is the cost of sale on our debit side, because normally we know that our cost of sale was supposed to go to the credit side. The cost of sale, the sales of where did we purchase our inventory? We purchased our inventory from who? From A limited. So cost of sale, then with the brackets will be A limited, which is 6,000, and then the contra account to the cost of sale is the inventory, which is the purchase, because it's the inventory that's sitting in our books. Inventory, because normally our inventory was supposed to be on the debit side, but because we are deducting it, so we're gonna put it on the credit side. Inventory, which is 6,000. So we eliminated the unrealized profit. So this is the elimination of the unrealized profit. And then now we're gonna go to the retained earnings. So the retained earnings, it will be so is the retained earnings of the 20,000, because here we're gonna make the profit also on this opening balance. Since the inventory was now sold, the 20,000, so there is a profit realized. So that profit realized, it needs to be eliminated because it's now included in the profit, on the profit of the parent. On the profit of the parent, they included the 20,000. So now we're gonna also eliminate. So we're gonna say the retained earnings. So we say 20,000 times 25 divided by 125. So it's 4,000. So we also need to eliminate this 20. Here is the elimination of the profit realized. So this was unrealized profit. Now, so here it's gonna be the elimination of realized. This one is the realized profit because the inventory is now sold. So this one, since we sold it, it affected because this profit is gonna affect the retained earnings, because whatever profit that we made, it's gonna go to the retained earnings at the end. So we say the account which is affected here, normally the retained earnings go into the credit side, but in this case, because we are eliminating, it's gonna come to the debit side. The retained earnings. So the contra account, which it will be the cost of sale, because this came as a result of the sales, the purchases that we acquired from our parent company, which is A limited. So this comes as a result of a cost of sale, the cost of the goods that we sold. So we have a cost of sale in the credit side. The cost of sale, it will be the 4,000 which comes as a result of that 20,000. So this 4,000 and the credit side is 4,000. So you must know the difference. So on the elimination of unrealized is focusing on the closing inventory. So here's focus on closing inventory. And then here focus is on opening inventory. Because this inventory, the one of the 20,000 is now sold. That's why we say it's a realized profit. So on from the general part point of view, they say is the elimination of unrealized intra-group profit included in the opening inventory. So from the last year point of view, it was an unrealized profit because it was not yet sold. So which it affected the retained earnings somewhere, somehow. So from the retained earnings of the current year, there is a profit realized at the beginning of the year. So we have to take it out. So if you want to, there is a thing that you call the test of your analysis. If you want to check if it's balanced, like if you take the at acquisition, if you take this 80,000 and then you add it with this, and then you add it with your 8,000, then they must give you this total of the 220 total. But I will show it in the next example. How do we deal with it? So now let's go to the consolidation part. On the consolidations, I'm not going to draft them, but I'm going to just explain so that we can know where does what comes from, because most of the calculation, they are now sitting here. Let's start with the statement of changes, profit and loss. We've got profit before tax, which came as the result of the 80,000 from the, if you go to your pre-adjustment trial balance, we have a profit before tax of 80,000 for A limited and the profit of 60,000 for B limited. So it will be the 80 plus 60, then they minus the 100,000. The 100,000 comes as a result of the sales made by who? By the A limited to B limited. So 100,000 represent the sales, the one which we eliminated there, this ones. 100,000 of the sales and another 100,000 of the purchases. So it's minus the 100,000 of the sales plus the 100,000 of the purchases. So it will end up being zero because it's the elimination. And then we less the profit from the closing inventory because it's still gonna be realized. We less it. And then we add the profit of the 4,000, this one. We add the profit of the 4,000 because this one is now realized on the retained earnings of the parent. Because when we were dealing with the retained earnings at the beginning of the year, which it was sitting on the 80,000. So now there is the inventory that was sold during the current year. So any profit realized during the current year, so the parent need to acquire it, that particular profit. So you're gonna acquire the full profit, which the profit realized is the 4,000. Uh, 20,000 times the 25 divided by 125, then it's the 4,000. So that's the fourth. If the 20 times 25 divided by 125, it will give you the 4,000. So now that 4,000 need to be included in the statement of profit and loss of the group because now the profit is realized. Because the profit was generated by who? The profit was generated by the parent. That's why we take the full 4,000. We don't take the percentage of the 80%. I mean, the percentage of the 80%, because if it was sold by, it was the subsidiary who sold the parent to the parent, and then parent sold outside the group. So we're gonna only take the 80% of that particular profit. But in this case, we take the full 100% of that 4,000, because initially it was the parent who sold to the subsidiary, and then subsidiary sold that particular inventory to the people outside the group, which is where now we say this 20,000 is now being sold. The 20,000 is included in the 90,000. It's now being sold to the people outside the group. That's why we take it in full. Are we clear up to so far, especially with the first line? I know it might be confusing. Tandeka? Tandeka?
It's clear, Mr. Mlapa. I think what helped me is the analysis of inventory that you did to show clearly the opening, the closing, and what was sold during the year. So
Okay.
it helped a lot.
Okay. And then Mulise?
Yeah, no, I'm clear. Thanks.
Okay. All right. And then, so it means after we did this unrealized profit versus the realized profit, there's no any other complications when we go down, because it will be an income tax expense, which is the same as the one took from the pre-adjustment trial balance of income tax as 30,000 plus 20,000. Then they give us 15. So our 138 minus 50 to give us the 88. And then we have our 88 as our profit for the year. So with the regard to dividing according to the attributable to the owners versus non-controlling, it comes from our analysis. The one that we did at the top, it comes from here, because we know that initially this one is the one which can affect our NCI in our statement of profit and loss. Then we go further to our balance. Okay, statement of changes in equity before we go to the balance sheet. So on the statement of changes in equity is also going to be the repeat of some movement. On the share capital is the 200,000 from the parent. We're fine with that. Then we go to our retained earnings. So the retained earnings from the book of A, because the one for 80,000 was eliminated when we were doing our pro forma journals. You remember we eliminated the 80,000 here. We eliminate our 80,000 on the retained earnings. This one is gone. And then when we go down to, because here it was eliminated, here's where the elimination was done on the retained earnings. So when we go down to the parent is sitting with 120. So it will be the 120, then we less the profit from the one, this profit, the one which was realized during the current year when we were selling the inventory to the people outside the group. So we less that 4,000 from the 120 of the parent. So we less the 4,000, and then we add with the profit realized by the subsidiary alone from the analysis of shareholders, that's 64,000, because this was the profit done during the retained earnings on the beginning of the current year from the subsidiary point of view. So we're going to add it there. And then we get our total of 180,000. So from the 180,000, then we add with the profit realized during the current year from our analysis, from our statement of profit and loss, the one which is attributable to the owners of the parent, which is 80,000. So when you say the 180,000 plus the 80,000 comes from the statement of profit and loss, then they're going to give you the 260. So we have the total, which will be the 200 plus 180, they give you 380, then 80 plus dash on the share capital, they give you the total of 80. And then the non-controlling part, we know the 36,000 comes from our 36,000 comes from our pro forma journals. If you turn to page 120, the NCI part, the 20 plus 60, they're going to give you the 36. So it will be your NCI on the balances at the beginning. And then the 8,000 it will come as a result of the non-controlling interest, the one for elimination, when you were eliminating from your analysis, from our analysis, this one, the 8,000. So the 8,000 will represent the one for during the profit realized during the current year, which is the same as the 8,000, the one which you showed on your non-controlling interest under the statement of profit and loss. And then we have your totals. Then we go to the statement of financial position. So our PPE is fine. It will be 200 plus 200 is fine. The inventory part. So here they said is 50 inventory for the parent as a closing plus 30 of the inventory for subsidiary. But out of that profit for out of that inventory for subsidiary, there is unrealized profit of how much? The one we did here. There's unrealized profit of 6,000 because the inventory is not yet sold. So this 6,000, it needs to be taken out so that we remain with the inventory without the profit. Because remember, we were the parent sold to the subsidiary, and then subsidiary will end up selling the inventory to the people outside the group. So that profit, which is not yet realized, we need to take it out. So that's why they show the 30,000 times 25 divided by 125, which is going to give you the 6,000. So we take it out there. Then the trade and other payables is fine, 70 plus 50. And then the share capital is the 200,000 from the parent. Then the retained earnings is the 260 from our statement of changes in equity. And then when we add the two, they give you the 460. So the non-controlling interest, it will be the 44,000, which is the 44,000. It comes as a result of the 36 plus 8. The 36 is from the opening balance of the NCI when we are doing your pro forma journals, plus the 8,000 of the movement for the current year. So they give you the 44,000 to represent your NCI. Then from there, you go to the current liabilities, which it will be the 30 plus 60, which will give you the 90,000. So all in all, this was the situation where the parent sells inventories to a subsidiary. So when the parent sells inventories to the subsidiary, there is no much impact on the analysis of shareholders, but more impact it will be in the the statements. You can use the more impact going to be on the statements. It will be more impact on the statement of profit and loss, more impact on the statement of change in equity, and then the decreasing of the profit from our inventories. And then on the next, okay, let's go to the comment and see before we can go to the example 2, whereby in example 2 it will be the subsidiary now selling inventory to the parent. So on the comment, they note that in this example, the parent sold inventory to the subsidiary, and then the unrealized profit was therefore included in the profit of A Limited, because A Limited made a profit from that inventory sold to B. And there were consequently no adjustment in the analysis of the owner's equity of B Limited, but only in the consolidated statement of profit and loss and other comprehensive income. Also note that sales and the cost of sales are not always given in the question. You will then have to make all adjustment against profit before tax. So it means most of the things, our profit, those unrealized profit, they will be more affecting your profit before tax. It's not going to have to determine your sales, have cost of sales, and then it's like you're drafting the whole income statement. No, normally you'll be starting from the profit before tax. It is very important to understand the journal entries. When you know which accounts needed to be debited and credited, you will know where the amounts should be added or subtracted in the statement. That's why it's important that if you do your elimination, at least try to do the individual journals of these particular people alone before you transfer them to the elimination part, so that they can be able to know what need to be debited, what need to be credited. So it's important to do this kind of your the individual journal of that particular company, because here's what it was: the journal of A Limited alone, and then that other one was the journals of and then this one is the journal of B Limited alone. So it's important to have your separate journals of the companies alone before you take them into the group. And then we need to eliminate all intra-group transactions. When a shareholder or the outsider evaluates the group statement, the group is regarded as one economic entity, as the single entity will not enter into transaction with itself. We should eliminate any sales between companies in the group. Therefore, we need to eliminate the intra-group sales of 100,000, like the 100,000 of the sales versus the purchases, it was eliminated. Therefore, we need to, well, as mentioned in point 3 of the additional information, when the sales took place, A Limited credit the sales as it sold these goods, and B Limited debit inventory with the purchases. We assume B Limited sold inventory and hence had already affected the cost of sales. To eliminate the intra-group sales, we debit the sales of A Limited with 100, hence subtracting the amount from the sales. We will credit the cost of sales of B Limited, hence decreasing cost of sales. A Limited sells inventory to B Limited at a profit of 25%. So that is their markup. Both B Limited inventory left at year end and A Limited profit include this intra-group profit. Since we evaluate the company as a result as a single entity, we need to eliminate the intra-group profit, unrealized profit, as it was profit earned from within the group but not had been realized outside the group. At year end, B Limited has inventory obtained from A Limited in its financial records amounting to 30,000. A Limited made a profit of 25,000. To calculate the unrealized profit portion, we have to recognize that the 30,000 already includes 25% profit, which makes it 125. We calculate the profit of 25% as follows: 30 multiplied by 25 divided by 125, which will give you the 6,000. And then to eliminate the unrealized profit, B Limited has to subtract the 6,000 from its closing inventory in the statement of financial position. We therefore credit inventory to decrease it. We should also decrease A Limited profit by debiting the cost of sale. Profit decreases when we debit the cost of sale, but 6,000 is added to the cost of sale, referred to the journal entries. In the previous year, the journal entry for eliminating the unrealized profit of 4,000 was performed similar to what is described above. So in the prior year, they did do the same journal for this particular 4,000 in the prior year. The 4,000, it was sitting here. It was elimination of the unrealized profit. So they did the cost of sale as 4,000 and inventory as 4,000. So in the current year is the reversal. So we have to repeat all the entries annually because we combine the individual company's financial records annually, and this current record does not contain the consolidation entries of the prior year. If profit was affected in the prior year, we need to adjust the retained earnings in the current year. Therefore, the cost of sales of 4,000 that will have been debited in the prior year will be debited against the retained earnings in the current year. Due to the general view that the operating cycle of entities is normally a year, we assume that B Limited usually sold this inventory to the outside parties within a year. Hence, the profit is realized. Therefore, we credit cost of sale in A Limited to increase the profit again, and crediting the cost of sale, that implies the cost of sale decreases so that the 4,000 is subtracted from the cost of sale in the statement. So in example 2 is the situation now where the subsidiary is selling the inventory to the parent. So subsidiary is going to sell inventory to the parent, and then parent, we assume that it's going to sell the inventory to the people outside the group. But now remember, now this is the two, it will be the same group. Like it's like we as the group, we are selling inventory to the people outside. So the profit realized by the subsidiary, it's going to affect the analysis of shareholders. So in the current year, because normally on our analysis here, for the profit, we didn't do anything when the parent was selling to the subsidiary. But in the situation where the subsidiary is selling to the parent, that profit realized by the subsidiary, it need to be taken out here. So whatever profit which is going to be done by the subsidiary, we're going to take it out on our analysis of shareholders. So it's important to note who is selling to which company. So we've got two companies, which is D Limited and E Limited. D is the parent, E is the subsidiary. Then D acquired the interest in E Limited at the time of incorporation. D Limited purchased all its inventories from E Limited. So you see, D purchased inventories from E. So it means E is selling to D and at the cost plus 25%. And the inventories in D Limited amount to 40,000 on 1 January. So on 1 January, inventory was 40,000, but at the end of the financial year, the inventory of D is sitting at 50,000. So, and they made the purchases of the 100,000. So it means it will be the 40,000 plus the 100, then less whatever sold to the public, which will be the balancing figure, and then the closing is sitting at 40. Then draft the consolidated annual financial statement of D Limited Group for the year ended 31 December 2008 in compliance with the requirements of International Financial Reporting Standard. So we're gonna also again start with our analysis of the shareholders, which normally they will just look the same, except the only portion that is gonna have impact, it will be here. The current year portion here is the only where they're gonna have the difference. So hold on, I just wanna okay, this okay, this will be my example 1. And then we're gonna have now we have example 2 on page 122. So it will be the same format where we're gonna do our analysis of shareholders as usual. Analysis shareholders, which normally this is for B Limited, I mean E Limited as a subsidiary. DD as subsidiary. And then it will have the same thing we know, total, the add part, or we say is E Limited, D Limited at 80%, G Ltd 80%, and then which is gonna have the add and the scenes part, the NCI. So the share capital we already know, nothing changed. It will be the similar to the exercise in the prior one, the prior example. So the share capital is 100, and then the 80. I'm gonna just run fast here so that at least we able to tackle the elimination part. And then the 20. And then we have our totals for the consideration given, which it will be 80. Consideration. And then we have since acquisition. So here they should be sitting at 20. And then we have since acquisition to BGN. So the retained earnings, now have a look. You see, the difference between the two, when you were doing with the one of parent selling to subsidiary, if you can check to page 119, you just said the retained earnings to the beginning of the current year, it was straight in full as 80,000. No problem. But this one is not straight as 80,000 because the reason being, in this case, is the subsidiary selling to the parent. So when subsidiary is selling to the parent, at the beginning of the year, there was a unrealized profit or the realized profit from the inventory at the beginning. Like if you check, there was an inventory at the book of 40,000. So on the prior year, when they were closing the book on the prior year or 2007, they had unrealized profit. They did the same journal as this one. They did the same journal as the elimination of the unrealized profit here. They had the cost of sale and the inventory as it was the closing part. So now whatever you closed, you need to open. So when you open, we're gonna open with the 40,000 of the one which it was now. It was a closing last year. Now it became an opening. So we have to deduct the same profit from our retained earnings. So we're gonna have the retained earnings here. Which is the balance of the 80,000 from E Limited as normal. It was 80,000. Then we less the unrealized profit from the opening balance. So it will be the same scenario as here for B Limited inventory. Sorry, is E Ltd inventory opening as 40,000 as given on 1 January, 40. And remember, this inventory is purchased from who? Is the one which is now sold, because remember, in this case, is subsidiary selling. So we have the opening inventory of 40,000, and then we're gonna have the purchases. But the purchases in this case, they are coming from the different people. It's not within the group. So it's purchases outside the group, from outside, which is 100. And then, or we can, and then we have the purchase, it can be in the balance figure because we don't know how much was sold. But this one, it will be the purchase from outside. It will come as a balancing figure. We don't know it yet. And then we have the sales to D, which they told us that the total sales of E limited to D is sitting at 100. And then they tell us that the closing inventory of E limited is sitting at 30. So the closing inventory is sitting at 30. So our purchases, I'm still calculating. 10 times 10. Let's do this given. So this one will present our intercompany intra-group transaction. So now, because on the last year when we were closing our book, we had the closing of 40,000, and we calculate the profit which was not yet realized to the people, was not realized yet. And then now on the current year, when we open, this 40,000, it's gonna be sold to D Limited. So out of this 100,000, there is 60,000 of the current year plus the 40,000 which comes from the inventory of the prior year. And in that inventory of the prior year, we already had a profit in it, which it was, we had an unrealized profit here. There was an unrealized profit of which it will be the 40,000 multiplied by 25 divided by 125, which equal 40 times 25 divided by 125. 40,000 times 25 divided by 125. We had the unrealized profit of the 8,000. Of 8,000. So this unrealized profit of 8,000, it was unrealized last year, but now in the current year, it needs to be realized, this profit. Because the inventory was sold. Like this inventory is now included in this 100,000, it was now sold. So since now is the profit which is realized, you have to show it on your retained earnings. So on the retained earnings, you're gonna less the 8,000, which comes as a result of this calculation. So our opening inventory affect the retained earnings in the books of, in the analysis of shareholders of the subsidiary. So you less the 8,000, and we remain with 72. and then the percentage 57.6, which we know how we arrived there. And then we have the difference of 14,400. And then now it will be the current year. On the current year, okay, before I proceed, are we happy with the 8,000 affecting the retained earnings at the beginning of the year?
Yeah, I'm happy with it.
Okay.
I'm good with it as well.
Okay, cool. And then when we go to the current year, it will be the profit of the subsidiary. So let me do the calculation with the profit for subsidiary. Let's like the mini income statement, mini income statement, which normally it was gonna be the profit before tax or tax of how much, which it was 60,000 as shown from the pre-adjustment trial balance, the 60,000 of the profit before tax, 60, and then we less the unrealized profit. So the unrealized profit, because this one here, it was the unrealized profit when we were closing the books. But me now as a subsidiary alone, like this is the income statement of the subsidiary alone. Now the subsidiary, he realized he got that profit. So subsidiary. So subsidiary now got the profit. So he gonna add on his books, like he add the profit realized from selling this, because this it was now sold in the current year. It was included here because it means the 40,000 it comes from the prior year, the 60,000 comes from the current year. So you add the profit based on the one which was the unrealized profit in the last year. So you add the, which will come as a result of 40,000 multiply by 25 divided by 125, which it gives us the one of the 8,000, right? I have a problem with my keyboard. Have a problem with the 8. Then we add a profit, which is 8,000. Then we less unrealized profit. So this one is the realized one, because the inventory was now sold to the parent. But this one is less unrealized profit because on this one is not yet sold to the parent, which represent the 50,000. When you check on the closing inventory of a subsidiary, our subsidiary is having a closing inventory of let's say the profit for the 60,000 plus 20,000. The 20,000 that we added comes from the income taxation, and then the 50,000. Hold on, 20. So if you check on your pre-adjustment trial balance, there is an inventory of 50,000 on delimited. So that is the inventory sitting at the end of the year. Out of the sales that we made to delimited only sold the 50,000. So there is another 50,000 sitting, which is still gonna be sold to the people outside the group. which it will be sold next year. So here we say the unrealized profit, it comes from closing inventory of the parent. Because if you check the closing inventory of the parent, we are having the 50,000. So this is unrealized profit because it's, the parent has not yet sold that particular inventory. You're gonna sell it next year. But remember, on the other side, that time when we were dealing with the one where this, the parent was selling to the subsidiary, we had an unrealized profit of the 6,000 because it was still gonna be sold in the following year. So this one is affected only the books, like the statement of profit and loss only. But in this case, the unrealized profit, since we are dealing with the books of the subsidiary, it's gonna also affect his analysis of shareholders. So on the analysis of shareholders of the subsidiary, we have to take that unrealized profit comes from the closing inventory of the parent. So our closing inventory of the parent, it was sitting at 50,000. So it will be the 50,000 we multiply by 25. Divided by 25. I'm sorry, multiply by 25 divided by 125. Then we have equal 50,000 times 25 divided by 125. It's gonna equal the 10,000. So we say 10,000 here, it must be deducted. This one we add. And then the last part, it will be the taxation, because we have the income tax expense of 20,000, then income tax expense, income tax expense, which is 20,000. Then when we sum this, it will be 38,000. So our 38,000 is will represent our profit realized by the subsidiary alone. So this is the profit realized by the subsidiary. So we have to take it further to here is the profit for the year. Profit for the year is 38. 38. And then we do our percentages as usual. Then it will be 3,400. And the 7.6. And then we can have the totals. So our totals will be, sorry, capital letter T, totals. We add all these together. Add them all together. And then we do ours. This one is closed. And then we add this together again. All this. Oh, sorry. And then sum all this together. And then, sorry, I did something, or this one should be balances. Then we add until here. Then there is a thing called test of analysis. Test of analysis. So your test of analysis is like you are checking whether this balance or not balancing. So you have to, you're gonna say this plus this, and then you add with this. So if you add this, they must give you this, they must equate to the same value here, 210. So it will be the add is 80. And then you have your since, which it will be the 57,600 plus 3,400. They give you 57,600 plus the 3,400, which equal 88. And then you have last one, which it will be your NCI, which it comes as 42. 42.